Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my co-host, Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the Exit Readiness Podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value and for planning your eventual exit and inevitable exit from the business. We want to help you build a business that's sellable and help you exit successfully on your own terms and conditions. Walter, you're right in the middle of tax season, so this should be an easy question for you to answer, my friend. What is a common characteristic of not only our exit planning clients, but all those tax clients that you're having fun with right now?
Thanks for the easy question, Pat. I'm not going to say that all my clients hate to pay taxes, but I will say they certainly don't want to pay any more taxes than they legally have to. Mm-hmm. And that's exactly what we're going to be talking about today, saving taxes and specifically saving state taxes upon the sale of a business. Our topic today is saving state income taxes by selling a business through a Delaware Trust.
Yes, and our guest today has many years of experience in helping business owners do just that. Kalimah White is the Senior Trust Advisor leading TD Wealth's Trust and Estate Services to high net worth individuals and institutional clients. Prior to joining TD Wealth in 2017, Kalimah held roles as Senior Trust Officer at J.P. Morgan Trust Company of Delaware and as the National Practice Manager at Nat City Trust Company of Delaware. In addition, Kalimah has practiced trust and estate law with a prominent law firm in Philadelphia. She's an undergrad. Her undergrad is from Temple University as well as her law degree. So we have with us a very knowledgeable and experienced expert on a topic that can much benefit an owner who is selling and wants to minimize state taxes. Kalimah, welcome to the podcast. Thanks for joining us here today. We're grateful to have you.
Appreciate it.
Hey, Kalimah, thanks for joining us.
Thank you.
So before we get started, I would assume that about 99% of our listeners are not familiar with a Delaware Trust. So before we dig into the details, can you just give us like a fairly simple example of just kind of how they work?
Sure. So what we're talking about here is a business owner creating a personal trust. And so in this situation, they are able to create these trusts and contribute their assets, their business assets, to this personal trust and sell their business and be able to minimize or eliminate state income tax. So say, for instance, you have a business owner in New Jersey and they have a business worth about $11 million and with a low cost basis of about $1 million. So the client sells the business for $11 million. So they would have to pay federal tax about $2.38 million in federal capital gains tax, and then a New Jersey state income tax of, say, over $881,000. So if in that same scenario, if that client had contributed the business assets to a Delaware trust before selling their business, and they sold the business later, maybe a year later, and in that instance, they would be able to save on the state income tax of $881,000, even though they'll have to pay the federal capital gains tax because, as I like to say, the feds always want their money.
Kalimah, let me ask you a question. Being a tax professional, it just strikes me as interesting that a lot of different tax strategies start with the name Delaware. Right. Why is that exactly? Delaware is a little state. What's going on up there?
Well, Delaware really has in the past many years, the past 20, 30 years have, been really innovative with regard to their trust and tax laws. And they really want to be the premier state for this, these types of techniques in helping clients. And so not only are the attorneys and the trust companies in Delaware, the trust industry, very committed to making sure that Delaware has the best trust and tax laws, but they also have this wonderful court system in the Delaware Court of Chancery that is very, helpful and thoughtful. There's case law with regard to a lot of these statutes where a lot of the different States, they don't have this type of industry. They don't have the foundation. And a lot of states actually copy Delaware's trust and tax laws. Connecticut just passed a new Trust Act. And in their Trust Act, they copied a lot of Delaware's laws. New Hampshire just copied it all together. I don't think they even made changes to anything.
Yes, so piggyback on that question, Kalimah, of course, we're aware of the Delaware Statutory Trust. And today, just to be clear, we're talking about the Delaware Trust, not the Delaware Statutory Trust.
Right.
Can you give a brief description, contrast to both those different trusts?
Well, the Delaware Statutory Trust, I think a lot of times it can be very, it's a type of a trust. The name isn't really true because a Delaware Statutory Trust is really a corporate trust, right? It's sort of like an entity like an LLC, and it allows you to do things like that. We're talking about Delaware trusts that are personal trusts that are set up for estate planning, like you would set up a trust in Maryland or you would set up a trust in Virginia. And so these types of trusts that we're talking about are people set them up for estate planning purposes, to save on estate and gift tax, to save on state income tax, to have asset protection, creditor protection, to provide a legacy for their family going forward by creating maybe a dynasty trust. So all of these types of advantages are part of the Delaware advantages of a personal trust. And so, it can be a little the Delaware Statutory Trust part of it could be a little disingenuous and sort of throws people off. But in this instance, we're talking about creating a personal trust where the business owner would be the grantor creating this trust.
Okay, great. And Kalimah, I think just based on that discussion you just had, it's interesting because Pat and I are always telling our clients how important it is to look at their exit comprehensively. They have to have an estate plan. They have to do some tax plan. They have to do business value growth, all those things. And this technique, we're looking at it from the tax perspective, but it sounds like it's a lot more powerful than that, and it's really part of an estate plan to a certain extent.
Exactly. It's just one of the tools in the arsenal that the business owner can have with regard to selling their business and be able to plan their legacy. And it can do so many different things for a business owner, and not just right now in the sense of saving state income taxes, but then also in the future, ensuring that their legacy is protected.
And what do you recommend as it pertains to the timing of the transaction? How far in advance of the sale should a business owner contribute the business assets to the trust? Kalimah, oftentimes when we're helping a client think through business continuity in the events of early death, permanent disability, something like that, we'll recommend, particularly if it's a sole owner, it's often advisable for them to move that business into a trust to make it easier to continue the business if something were to happen to them like that. And so they would do that well in advance of, at times, when they actually sell, or certainly well in advance of when they pass away or become permanently disabled. What about the timing? What would you say in regard to the timing of the transaction, and how far in advance of the sale should a business owner contribute the assets?
And so I think in this instance, I think what you're talking about basically is business succession planning, right? You really have to be you have to really think ahead as to where you want to go with your business, if you're going to sell it or if you want to retain it. And so if a business owner is looking to sell their business, they are probably looking to do that, contribute that business to a trust well in advance, definitely at least a year in advance. And you want to, but I say as soon as you can, because there are a lot of reasons to do that, right? And a lot of business owners say, well, I don't really want to contribute my business to a trust because then I'll lose control over the business. The trustee will have control. But they're talking about a traditional trust structure. Now, if you're talking about a trust structure like you can have in many states like Delaware, a directed trust structure where there's a bifurcation of duties between the trustee and an investment advisor, and the business owner is the investment advisor, then that business owner can have total control over the sale of the business once they contribute those assets to the business. So even though a lot of times they worry about having control in this trust structure, they can retain control over the business, and on top of it, be the beneficiary of this trust, which is a very, very powerful tool as well.
So, Kalimah, most of the clients Pat and I work with, since they're predominantly located in this D.C. metro area, they're not your classic businesses with lots of equipment and making widgets and stuff like that. They're really more service businesses. So when we look at them from a valuation standpoint, the bulk of the value is really the goodwill that the company has built up over years of successful operation. Does that make them a good candidate for a Delaware Trust?
That actually does, in the sense of making them a good candidate to sell a business with those types of assets through a Delaware Trust and save on state income taxes. Because the reasons why states can tax, anything is because of the connection to the state. So if you have, source income, if you have real estate, the state is going to say, you're here, we want to tax you. But if you have intangible assets and you contribute those intangible assets like goodwill, a limited liability company, some type of entity into the Delaware Trust, then those things are, they aren't sticky to a state, right? And so it's easier for it's harder rather for a state to make a constitutional argument that they get to tax these assets. And so, having intangible assets and selling those intangible assets through a Delaware Trust is probably the best type of business structure for this technique.
That's good to know, because when you think about it, Pat, a lot of times our clients are selling their business and they would prefer to sell the stock. Yeah. But for lots of reasons, buyers want to buy assets. Sure. So if you put your business stock in this trust thinking you're going to avoid state taxes, but then the buyer wants to buy your assets, and you've got a bunch of physical assets, you've got some issues. But with our clients, it sounds like it's definitely a good opportunity.
And even in that instance, depending on the situation, you can sometimes wrap assets, even tangible assets, into an LLC or some other type of entity, and then be able to sell it from there. But that can be tricky in the sense of whether or not property taxes are taken out at the state level. So but there are definitely different techniques to maybe not avoid the state income tax altogether, but at least minimize it.
Yeah. When do you and TD, when you're serving one of your business owner clients, when do you start to talk to them about whether or not they should have a Delaware Trust or not? What are you looking for?
Right. Well, I think that, from my perspective, I talk to everyone about a Delaware Trust all the time, because, not only in the sense of saving on state income taxes, but for asset protection purposes, for legacy planning purposes. There are all different types of reasons to have, this type of trust. But for business, because TD, as we like to say, we're one TD. So we have a big wealth group, we have a big commercial group, we have a big retail arm as well. And we work a lot with our commercial group, with their owners who are looking to sell business. For instance, we have this financial planning tool that we call TD Wealth Plan. And in TD Wealth Plan, it's probably in the last 2 or 3 years that we've had this. And so I was really excited because when I first saw it, in the demo, there's a section in there to our clients about, are you planning to sell a business in the next 5 years? Right. And so they're able to then, to let us know, I'm thinking about selling. And so we encourage a lot of our, commercial lenders and our relationship managers to do, and I do as well, is to talk to our clients early about these techniques, because not only is it a situation where you're able to save state income tax, but a lot of clients are worried about asset protection. A lot of clients are worried about asset protection, and being able to structure your business assets into a trust that will give you asset protection as well as allow you to be a beneficiary of a trust. I mean, that's powerful. And you can't do that in too many states.
So, Kalimah, we're sitting here in Maryland, Montgomery County, Maryland, Bethesda. And
I love Bethesda.
yeah.
So quaint.
If you like restaurants. You like
That's
Bethesda.
true.
If you like traffic, you're going to like
That's
Bethesda
true. That's
too.
true. I'm from New York. Traffic is traffic.
Yeah. So a lot of our listeners, of course, are here in D.C.
Yeah.
Why would someone in Maryland establish a Delaware Trust instead of a Maryland Trust?
Right, right. Well, depending on where the client sits, Maryland actually does have decent laws with regard to trust laws, so that's a really good thing. But there are some different things that you can't do in Maryland, and in this instance, if you're looking to save state income taxes and you're a Maryland resident, the states tax your income in a trust, depending on whether or not they consider your trust a resident trust, right? And so in that instance, it's my understanding that in Maryland, they tax it of whether or not the grantor has created the trust during his lifetime or there's administration in the state as well. And so...
if you're the grantor of the trust, you're going to be taxed.
If you're but there have been case law that has been coming up through the ranks that may change that. And so, there are different cases and there's a case that'll be going to the Supreme Court that may change that. So it's always good to think about it this way. And so I always say that, if you're a Maryland resident, if you're a Virginia resident, having a Delaware trust, you're able to have asset protection. You're able to have that with a Maryland trust too, in the sense